so, they want to push it out so that they get their money back quickly. So it is generally, I would say it is an order for which lasts 24 months, but it's certainly between 6 months to 12 months the order would last.
So it basically it means that in terms of you would have certain visibility for the current year as well.
We have definitely we have the visibility for this whole year as you see.
And that looks reasonably robust as you see the order book as on now in terms of that looks reasonably strong.
Yes, it looks pretty robust, good, and then as we get into October, then our visibility will go into 25 mid, till that time.
Oh, I see. So, would it be, I'm not too sure, but is it possible for you to share some number in terms of the, say, order intake or something like that? Because, a macro tailwind, of course, is there for next 10 years for India, correct? Amrutkal is going on. But, that growth of 10, 20, 30, 40, there's a big difference between the two numbers, correct? And to that extent, of course, the profit variance is also very, very high. So, would it be possible, you might use in a different terminology, high teen, low teens, high 20s, low 20s, but some indicator definitely will be useful for us.
Yeah, so, I can tell you that it is robust. We have an order book which is very strong. Beyond that, obviously, I don't want to share. But as we speak, next 6-8 months are pretty robust.
Super. Sir, my second question is with reference to the automobile segment. Typically, the commercial vehicle, segment is a very bulky segment for you, and CV industry is right now going through the, what I would say, consolidation, or maybe a little bit, kind of downward kind of a trend. But despite that, our margins have improved because normally this is considered to be a little bit higher margin segment. So how we should read that? And despite CV kind of a little bit slowing kind of a growth, you still reported reasonably good number in a mobile segment. So how we should read this?
So obviously we have reported margins as a whole, not in mobile. We have obviously given the whole quarter consolidated margin. That is how it is. Now, if you want to say that the CVs were flattish and the rest was whatever percentage, as I said earlier I think Ankush was asking the question that, margin performance in the quarter is obviously, product and mix and leveraging the capacity always plays a role. And then our consistent work in the area of supply chain, steel optimization, extra, that plays a role. So our endeavor obviously always is to have a better margin, but sometimes the mix is to your disadvantage and sometimes it is to your advantage. So depending on the forecast and the buyers and things like that. So this quarter, the margin performance is, if I have to kind of say that, three major points is volume product mix, cost leverages which are there, and then Timken India Limited, we are relentlessly working with our customers on price realization, and we being kind of market leaders in asking for better pricing in the fraternity.
And inherently, the railways margins would be, compared to say company average margins, if you basically put this, which will be the highest and, in that order, say between railway and mobile and process and exports, how do you basically rank this?
I would not like to rank.
Okay. But at least railways will be, higher than the company average. Would that be a safe assumption?
I cannot give you my core competence and strategic pointers, but generally, I would say that the aftermarket is always around the globe. Any segment, aftermarket is always the most profitable.
Sure. And last question on my side, in terms of the competition, how do you see the competitive landscape, particularly on both railways as well as on the process side? Because the competitors are also entering into a few segments where Timken has a traditionally very strong hold. So would you like to comment on that?
Yeah, competitors always were there. The competitors and competition has been there and will remain there. And obviously, there are in this segment still today, there are only few companies which have the technology. There might be companies who have money to, say, buy a foreign nice, great grinding line, But then there is a lot of application engineering, customer engineering, product technology, manufacturing, which only a few companies have. And I'm not saying that the competition will not have everybody in this market over the years, but and this is a game where the mobile we had in 1998, the mobile handset we have today, you can understand what is the technology change happening. The car which I drove first time when I joined Tata Timken back in 1990, the premium Padmini, I used to carry all the spark plug, pana, petrol bottle, everything. Now I don't know the key there. So, so all that put together, I would say that, the parent is, relentlessly innovating, and obviously other few companies are relentlessly innovating, and this market needs innovation. And then, new segments, sunrise segments are coming. For example, I'll give an example that the solar used to be fixed panel. Even in India, till last year, it was generally fixed panel. And then all of a sudden, people understood that, hey, you have to leverage solar to the maximum, and the sun direction to the panel is changing. Now rotating panels, which means small gearboxes, bearings, extracts. So that is one new segment, and not everybody will have the technology to cater to that. Food and beverage. Food and beverage, another segment. Very few people will have the technology to have that kind of bearings or solutions for these new industries which are coming up. And then obviously wind, very few companies will have the reliability to cater to, today it is in India 3 to 5 mega, but globally even 15 megawatt windmills are installed. So you need highly reliable, highly technologically advanced bearings. So we will relentlessly work on innovation. We are working on innovation, optimizing supply chains and things like that. So competition is welcome, and we will compete, and everybody will compete, and winning is important.
And what is your capex for FY25 and 26?
Sorry to interrupt, sir.
This is my last question.
Okay.
What is your capex for FY25 and FY26?
Okay, I think I'm just sure that I am not wrong. I'm just asking Avishant, our CFO, to check that. Sorry? More than 400 crores.
Combined. You mean both combined?
Both combined mean?
Or is it each year, or is it 25 and 26 combined?
I'm 24, 25, 400 plus crores. That includes 24, 25.
Yeah, you mean...
these two March 31st of purchase.
It means 31st March 25, you will spend 400 crores, correct?
Yeah.
Okay, and for 26?
26, I don't have the figures yet, but so this financial year will be 400 plus spending. 400 crores.
Super, sir. Wish you all the best. Thank you.
Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that management is able to questions from all the participants in the conference, please limit your question to 2 questions per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Rishabh from Premji. Please go ahead.
Thanks for the opportunity, sir. I would like to understand...
sorry, sir, you're not audible. Can you speak a little louder?
Am I audible now?
Yes.
Yeah.
Hi, sir. So my question is regarding the new capacity for the CRB and SRB. What would be the domestic versus export mix that we are planning? The CRB and the SRB mix is going to be, there are certain applications in this segment which are both available in, where consumption is in India and where consumption is outside. And these vary largely in the size range. The market largely is India, and also there's a nice market in ASEAN and a little bit in Australia as well. And obviously, it has a market in Europe and other places, but our focus on export it would be a little bit less, and it will be more domestic. And we are open to exporting more and more, but our first go-to market strategy on this definitely is domestic market, where we are already supplying tapers, and we are well entrenched with these customers, both whether it is material handling or it is cement or it is power.
power extra. So domestic is the priority, and there are markets in ASEAN and nearby countries which would also be catered. I can't give you the exact percentage. Focus is domestic for sure.
Okay. Sir, just a follow-up here. So if we were to sort of consider, let's say, 60/40 or anything more than 50 for India, our market share in SRB and CRB would grow a bit closer to double digit versus low single digit, if I'm not wrong, from recollecting from one of your calls. So if we were to sort of grow such a market share, what sort of competitive challenges that we might see, any margin pressures that might come?
So, currently we are selling SRB, CRB in India, and we are importing them from different parts of the world. So obviously, when you are domestically producing, your structure of the cost would be different than when you are importing. So that is one fundamental. You can't produce everything in one country, but whenever you are importing, obviously the cost challenges are more than compared to domestic production. And definitely our penetration in CRB and SRB is less. You are absolutely right, and it is a lot better in tapers. And the idea is that we grow into a double-digit penetration in this area in India, and that is the intent, and that is the path we are taking. And we have already started, testing certain part numbers, etc. So far so good. Looks pretty okay. And now we have to obviously complete the plant and start PPAPing and start selling. But the general direction is that we want to take the penetration single digit to double digit with this plant in India.
So you're confident that the margins won't be impacted despite such aggressive growth?
If every patient remains same, should have a nice impact, positive.
Okay. Thank you, sir.
Thank you. The next question is from the line of Abhishek from DSP. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity again. Two questions. First is, the parent has gone into a lot of M&A in terms of new products, which is coupling chains, belts, pulleys. Any thoughts of actually, starting the distribution of the same in the domestic market? Any thoughts, progress there?
So the whole concept, if you see, is that we want to be on the powertrain, which is right from motor up to the end, and it has coupling shafts, chains, pulleys, lubrication system, and the Timken globally has assured companies which would serve this dynamic powertrain and pretty much high-tech technological companies like Roll-On is, for example, one such company, and Grunwald-Becker in lubrication, and Lovejoy in couplings, and Diamond in chains. And definitely India is a growing market, and India is a great place to manufacture, great place to source, great place to export, etc. So currently this is an area where there is a chance for us to grow, definitely. And it is not only importing and selling in India. It is like, can we as a company create a supply chain model out of this place and serve the Indian market, serve the globe? Saying is easy, doing is tough. And we are looking at it. We are working on it. Say, for example, on one of the metros, we installed a lubrication system first time and running very successfully already. So we are looking at opportunities and seeing what is the best way to serve this market. And definitely this is a market which we should cater in India. This is a combined nice market. The parent has the technology, and that technology is available to us. Now, how to optimize the supply chain to cater to the domestic market, and at the same time, see if we can also be part of the parent's global supply chain model.
So, but any thoughts on the timeline, Dave?
Well, I cannot comment on the timeline as this creating supply chain is tricky in the sense that you have to either go and buy a company or build a company or have such capable companies in India which can become your source partner. So we are working on it. We have a small team working on it currently, but no timeline which I could provide. Though my intent is the timeline should be faster and faster, but currently do not have any such timelines in front of me.
Got it. So the other question is on exports, which has seen, at one point in time, exports used to contribute to more than 30-35% of your overall top line. In the current quarter, it has gone down to as much as 14%. And if you look at your overall EBITDA margin, still continues to be very robust. So, sir, in next couple of years, given the overall thing which is happening around the globe in terms of wind and other things and China Plus One strategy, you believe on a sustainable basis, given the way your domestic market is also growing, export should be more like a 25 to 30% of your overall top line contribution? Is that the way one should look at it? Any thoughts, sir?
Yeah, I will give you a short answer, yes, 25 to 30. That is the correct answer. The long answer, definitely India market is growing. And then, there is definitely China Plus One, which is going to and is benefiting India. A lot of manufacturing shift to India. And then, at some point of time, China Plus One competing against Indian cost, quality, delivery also will be challenge for other countries. So 25 to 30 is a safe range and a safe bet out of our total pie to be exporting. And we want to keep on serving our strategic domestic customers. So, we don't want to kind of drop any domestic customer for exports. Obviously, we want to serve all. And, as the market moves, so shall our capacities.
Got that. Thank you so much, sir, and wish you all the best. Thanks.
Thank you very much. And I think we are really close. I just want to also share, before I take the last question, that you already might be knowing that our CEO, Rich Kai, which he has shepherded the company very well. He is one of the longest tenured CEOs in his peer group for the parent. Worked professionally for almost 35 years and 18 years with the Timken company. But he led Timken, the parent, to a remarkable strategic journey and has transferred the company into a very nice, high-performing, diverse industry leader. And he has made up, I was about to say, unfortunately, Rich made a very personal decision several months ago to retire. And the company has already selected a successor. The board has selected the successor, and the onboarding process is on. And I'm happy to share Mr. Tarak Mehta is going to be parent's next CEO, and he comes from a very highly acclaimed company, ABB, and from September would be taking over, and Mr. Kai would work as an advisor to him for some months, and that would be one more change. And Mr. Mehta has been working in the industrial motion, which just now the question was asked about his expertise, and more than $10 billion worth of business he has been driving at ABB in the industrial motion segment, which is same kind of, beyond bearings, the powertrain piece of it. So that is another information. And with that, I can go to the last question.
Thank you. The last question is from the line of Bharat Sheth from Quiz Investment. Please go ahead.
Hi, sir. Congratulations on bouncing back really strongly. Sir, my only question is that within railway, the way it has grown, so can you give some color which segment is growing faster than, we are supplying to everywhere, and within that also a margin profile which is, give you better for margin?
So currently, if you see the last quarter, rail is the best performing sector, and the if I can say, the not so good or same is the heavy truck market. Heavy truck market has been sluggish, has not reached the peak of 2018, but rail has been our star for the quarter. And I said previously also that rail will keep on doing well over the years, though it might not be a hockey stick, but it will keep on doing well. Now, we are waiting for a government change and which might change policies or steady policies, definitely. Heavy truck scrap policy might be a move which the industry might need as the new government steps in. And if that happens, all of a sudden, heavy truck in India would be a hockey stick. But currently, as I see, the two areas which are performing well and will perform pretty well this year is rail, distribution and process, these three industries. And if the new government comes later in the year and decides to scrap the 15-year plus vehicles, then the demand for the heavy truck would certainly go very up. On the margin, I've been telling that, continuously that, we'll not obviously segment-wise give you any indication on the margin. But as a company, our strong margin has been this quarter because of the product mix and as a nice leverage on the cost, and obviously price realization has been strong despite challenges of the softening of the metal pricing.
So is it a fair assumption that railway is the highest, so better product means is rail generate little better than margin than the company level? And within rail, if you can give some color which is growing faster and which you expect to faster, like Vande Bharat, Wagon and other freight.
So in rail, actually, obviously we have to see the base. Freight has the largest base, so freight is growing. Metro has a very small base. It is growing, but obviously when you see the base is very small, even if it grows by 100%, the base is pretty small. Wagon base is big. There even a 5-10% growth is pretty significant in terms of dollar or INR. And certainly electrification is pushing the locomotives, and Vande Bharat in the passenger after wagon, that has the second largest base. Vande Bharat is following. So wagon consumption, I'm saying, if you see the whole pot, wagon has number one for the build side. I'm not saying margin side, for the build side, followed by passenger and then metro and locomotive. So that is how it's going to play out. And on margins, I am not advised to tell you the margins in segment-wise, but our endeavor is to obviously kill the race and work hard to make sure that we optimize costs wherever it's possible.
So do we believe there's a Q4 margin is sustainable for the full year FY25 or maybe some softness?
As I said that it is volume and mix driven. So some quarters go up, some quarters come down. So that up and down remains for every company. If your product mix that quarter was bad, so it can come down. But what is sustainable is how your supply chains are behaving, and if you have good demand, then how do you leverage that volume, which is very, very important in our industry. So the endeavor is obviously profitable growth, and quarter to quarter mix will play its role.
Okay. Thank you very much, sir, and all the best.
Thank you so much. Thank you very much. With that, thanks a lot for the questions. I always learn more from the questions. I hope you got the answers, and thanks a lot for Spark for coordinating. Thank you and Jai Hind.
Thank you. On behalf of Avendus Spark, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.